So, very warm welcome to everyone on this very glorious day. So, we can all be very proud that we are contributing to some extent to our nation building, which our Honorable Prime Minister has mentioned today in his Independence Day speech. So, with that note, we start with the webinar. The idea of the webinar is to give a brief intro into the individual taxation aspect, which was brought in several amendments in the Finance Bill of 2024. So, there was around 87 amendments in this bill, out of which we try our best to cover those aspects which will be impacting the individual taxpayer or the salary taxpayer. So the first aspect of the bill, which is the income tax, the direct taxation. So the gist of the direct taxation that we are going to discuss today is that there is no change in the tax rates except the new tax regime. That is, the government has slowly let the old tax regime to have a slowdown, and we are going ahead with the new tax regime. So they have not touched anything or not made any amendments to the old tax regime, which in a way gives a indication that you can forget the old tax regime. It's going to be let it go as such, and we are going to focus and go ahead with the new tax regime. Now, the main impact here is that the old tax regime, which is a more saving centric regime. That is, you have some tax benefits given for your savings that you are doing, like your PF, your LIC, etc. Whereas the new tax regime has is having a more westernized point of view. That is, you earn, you spend, you enjoy your life. So the savings is entirely on the individuals to take care of their own security. Because unlike the Western countries, we don't have a very strong social security system in our country, which the government cannot provide given the population and the economy that we are having currently. So it is wholly upon the individual for their own individual benefit, for the benefit of their family, that you continue your savings, you continue your insurance, you continue your Mediclaim insurance. Do not think that you have to give away all that because you don't get any tax benefit. Because end of the day, it is not just for tax benefit. The crux of the insurance is not to provide you a tax benefit. It is to give you a security. Is to give a security to your family, is to reduce the financial pressure that you may be facing in the event of any contingencies occurring. The next significant part of the discussion today will be the change in the capital gain, long term as well as the short term. So first look at the interest, your tax rate changes that is brought into the new regime. The old regime remains as such. The new regime, if you see, they have raised the slab to the extent of 1 lakh. That is, for a 5% up to 7 lakhs, you are having a tax slab of 5%. Earlier, it was just 6 lakhs. Similarly, if you see the second slab of 10%, earlier it was 9 lakhs was a slab limit. Now they have raised it to the 10 lakhs. So these are the two changes that they have made in the tax regime. So other than that, once you exceed the 10 lakh slab, your income will be taxed as it was earlier. There's not going to be any impact. So the savings that you are going to get due to this change in the slab rate will be a net of 10,000. Now, this is a brief calculation that we are giving. We are not saying that a person getting a 10 lakh salary is going to have this impact, because there are so many other aspects which we have to consider while computing the tax liability of that individual. But however, this is a rough calculation that we have put up from our end. If you see, a person who is in the tax slab of 7 lakh is going to get a tax benefit of 5,000. And similarly, when he goes to the tax slab of 10 lakh, he will be getting the impact of another 5,000. So anybody who was having a taxable income of 10 lakh or above, due to this change in the new tax regime tax slab, they will be getting around a net benefit of 10,000 rupees. So this is the benefit out of the first amendment that we have discussed here. Now, what happened to the 87A relief? So 87A relief remains as it is. That is, you will be getting the tax exemption up to your tax slab of 7 lakh. That is, if your salary or your income doesn't exceed the 7 lakh slab, your whole income will be exempt from tax. If it is going to exceed 7 lakh, your total income will be taxed as per the slab that we had seen earlier. Now, another key point that we have to keep in mind with regard to this 87A exemption is that this rebate is not available for Section 112A, which means it is not available for the long-term capital gain that you will be accruing out of your sale of shares or equity-oriented mutual funds. So for those kind of long-term capital gain, this rebate is not applicable. Now, what is the change in the surcharge? Have they brought about any change in the surcharge? No. The surcharge limit remains as it is. In the old regime, your surcharge was 37% if the tax slab is 5 crore. If not, in the new regime, if you are coming to the new regime, it is 25%. So the last slab that you see for the 5 crore is the difference between the old and new tax regime impacting the surcharge. Now, what are the other benefits that the government has given to us, or what are the other amendments that have been brought from the individual taxation point of view? That is another significant thing, which is not an amendment, but again, it is same thing that you have done in your last year. If you don't want to go ahead with your new tax regime, if you feel on the basis of a professional calculation that your old tax regime will be more beneficial to you from the tax outgo point of view, then you have to exercise your option to opt out of the new tax regime. This is the same process which was there last year, and the same thing continues. So the default tax regime is new tax regime unless you opt out of it. Of course, the changes are effective for the financial year 2024-25. However, the various amendments have different date of effect, which we will be seeing as we go forward. Another key impact that we have seen is the change in the standard deduction. Now, please note the change in the standard deduction is only and only for those who are opting for the new tax regime. So, if an individual is opting for a new tax regime, his salary income, which will be awarded with a standard deduction, it has been enhanced to 75,000. An individual who is earning salary, if he opts for a new tax regime, he is eligible for getting a standard deduction of 75,000, whereas an individual who is opting for an old tax regime will continue to avail a standard deduction of 50,000. So this is the important significant change which gives some relief to the salary class. There has been a change in the family pension income part also. Earlier, the deduction available for the family pension income was 15,000. Now it has been enhanced to 25,000. So a maximum of 25,000 is reduction you will be getting for your family pension. Now, let us quickly see what is the impact that is going to happen to the higher income slab. Those who are in the income slab of like 15 lakh or to 1 crore, how far are they going to get benefited? The first benefit that they will be getting is the reduction of the tax amount by 10,000. If you opt for a new tax regime, you are going to get the benefit of 10,000 tax reduction compared to previous year. Okay? So please note this comparison is only for previous year new tax regime versus the current financial bill new tax regime. So what is going to happen? in the current year new tax regime versus what was there in the previous tax regime. So yes, there is a benefit of 10,000 rupees, and they have also increased the standard deduction from 50,000 to 75,000, which will give you an approximate tax saving of 7,500. So with that given structure, so this is what you will be saving. That 17,500, which our finance minister had mentioned and which many of the news correspondents has mentioned, like 17,500 was the figure which was mentioned with regard to the tax saving for a salaried individual. So this is how that 17,500 is coming to the picture. Yes. So as we know, NPS of an employer contribution is one deduction that has been extended to the new tax regime also. The employee deduction of NPS, which was there under ATCCD, will not be extended to the new tax regime. However, the employer contribution to your NPS account, yes, that benefit is again extended to the new tax regime. So the employer contribution had a cap of 10%. They have now extended to 14% for non-government employees. So this benefit is in turn beneficial to the employer also. He will also be able to avail the deduction under section 36(1) when the employer is paying his tax, when your company is paying the tax. So yes, this is a welcoming change. So if you are in a position where you can negotiate any salary structure change, then you can opt for this 14% contribution to NPS, which is in turn a form of savings to you. Yes. So what is the change in house property? House property head, there has been no change. The only thing that they have made clear by an amendment is that any income from a house property will be treated as a house property income. You cannot tax it as a business income. Why? Because certain individuals who are having like 10 house properties, they are giving it for rental. They have been filing it under business income. So they have made it very clear through the amendment that whatever be the number of house property you are owning and whatever be the amount of your rental, the entire income from the house property will be treated as income from house property alone and not a business income. Yes, this is very, very significant aspect and a bit confusing also, which is we have tried our best to make it simple so that it is understandable to everybody. Now, what is the change that has been brought forward with regard to the capital gain? Through the Finance Bill 2024, they have changed the holding period of the capital assets. Earlier, the listed shares had a holding period of 12 months. Immovable property had a holding period of 24 months. Again, units of debt-oriented mutual funds had a holding period of 36 months. So for simplifying this and for easy computation of the capital gain profits, they have split the holding period into two. Listed shares will continue with a holding period of 12 months and all other assets will go ahead with a holding period of 24 months. Why this holding period is significant? Yes, the holding period is the one which determines whether your profit on sale of that particular asset has to be treated as a short-term capital gain and long-term capital gain. As we know, the rates applicable for a short-term capital gain are different from that of a long-term capital gain. So yes, listed shares have a holding period of 12 months and all other assets will continue to have a holding period of 24 months. This is a change, significant change, which has been brought in a capital gain structure. It will have an impact, especially if you are having an immovable property and you are planning to sell it on a short-term capital gain. So yes, it will have an impact on your tax computation. So when is this change applicable? It is applicable from 23rd July 2024. So what will happen to the sale which was made prior to 23rd July 2024? Let's assume you are selling your um, debt-oriented mutual funds on 1st of May 24. Then those assets and that gain will be computed as per the um, law which was in force at that time. That is, the holding period for that particular asset will be treated as 36 months. And for any kind of sale which is happening from 23rd July 2024, the holding period of those capital assets will be treated on the basis of the revised holding period, which is 12 months or 24 months as the case may be. So yes, this date of application, that is 23rd July 2024, is very, very significant. So for any sale that is happening prior to that date, the existing law which was there in force at that point, that is the Finance Bill 2023, will come in force. And for those cases which is happening, or those sales which is happening after 23rd July 2024, you will be following the revised holding period, that is 12 months or 24 months. Now, what about the changes in the capital gain rate? So earlier, the share equity oriented mutual fund of the equity shares, which was sold on a short term capital gain, were taxed at 15%. Now they will be taxed at 20%. So if you have any gain from the sale of your equity shares or equity oriented mutual funds, that gain is going to be taxed at 20% and not at 50%. Again, the date of sale is very relevant. This is effective from 23rd July 2024. So for those sales which happened prior to 23rd July 2024, they will be taxed at the rate of 15%. And the sale that is happening after 23rd July 2024, the revised rate of 20% will be applicable. Now, what is the change that has been brought forward for the long-term capital gain on sale of your equity shares and equity-oriented mutual funds? They have revised the rate from 10% to 12.5%. Yes, indexation benefit was not available earlier, which remains the same. So there is no indexation benefit which is available for sale of equity shares or equity-oriented mutual fund. The rate has been revised from 10% to 12.5%. This long-term capital gain on sale of equity shares and equity-oriented mutual funds have an exemption limit of 1 lakh. So if your gain is 90,000, it is wholly exempt. If your gain is 1,10,000, you get an exemption of 1 lakh. The remaining 10,000 will be taxed for your capital gain with the applicable rate. Now they have increased or enhanced the exemption limit to 1.25 lakhs. That is, you will not be liable to pay any capital gain tax on the sale of the shares provided your gain is 1.25 lakhs. If your gain is 1.3 lakhs, you will have to pay the tax on that 5,000 rupees. So this is the changes with regard to the equity shares. Now, what happened to the listed bonds and debentures? The listed bonds and debentures, as well as immovable properties, if they are having short-term capital gain, they will be taxed as per your applicable tax slabs. Okay, whatever is your income, total income slab, whatever slab is applicable, they will be taxed accordingly. That remains the same. There is no change in that. Now, what happened to the long-term capital gain on the sale of the immovable property? The long-term capital gain all along had a benefit of indexation. That benefit has been removed with effect from 23rd July 2024, which means if you are selling a house property after 23rd July 2024, you will not be eligible to have any indexation benefit. If you are selling the property prior to 23rd July 2024, you are eligible for the indexation benefit and the gain will be taxed at 20%. After 23rd July 2024, whatever sale is happening is going to be taxed at 12.5%. Now, there has been several WhatsApp forwards which says, yes, indexation is being granted. Yes, they have extended the indexation benefit for this year also. So what is that benefit that the government has given? That we will look in the subsequent slide. Yes. So the benefit of indexation is available only to the extent of your tax on the gain. Okay. So the benefit of indexation is not extended to computation of the gain. It is extended only on the tax on the gain. Let us see, for example, you are selling a property on, say, today we are on 15th of August, 15th of August, auspicious day, you are selling your house property. Then you are getting a gain of, say, 10,000 rupees. So let's assume that the new amendment, that is 12.5 percentage without indexation, you are liable to pay a long-term capital gain tax of 5,000 rupees. And if you apply indexation on the sale, you are liable to pay a tax of uh, 4,000 rupees. Okay. So you will be taking this 4,000 rupees and not the 5,000 rupees. Okay. So this is the benefit that they have extended. This doesn't mean that you will be able to carry forward any long-term capital gain loss on the basis of the indexation. No, that is not possible. If suppose your tax outgo is less, if you apply the indexation, then you can go by the indexation along with the indexation. If your tax outgo without indexation at the rate of 12.5 percentage is lower, then you will go by that way. However, you are not eligible to carry forward any kind of loss that you will be computing on the basis of indexation. So please understand the benefit of indexation has been extended only for computation of your tax outgo or only to the benefit on the tax outgo, not on the capital gain part, not on the gain part, but on the tax part. So yes, this benefit is again available only for those properties which are sold prior to 20, that is acquired prior to 23rd July 2024. This benefit of indexation on the tax which we have discussed is available only for those property which were purchased or acquired prior to 23rd July 2024. For all those properties which were acquired after 23rd July 2024 and sold subsequently, they will not be able to avail this benefit of indexation. This extended benefit of indexation is applicable only for those properties which were acquired prior to 23rd July 2024. So what is the impact of the change of long-term capital gain? So how are you going to be benefited by the indexation is taken off, or are you going to, have a better tax savings without indexation? So let's look at that. If you see the first column, the sale value is 100 and you have a cost of acquisition which is 20 rupees and the gain part is 80. So without indexation applying 12.5 percentage, you are going to get a tax outgo of 10. Okay, on this 80. Now let's assume you are having the benefit of indexation and the indexation benefit comes to 72.6. So your long-term capital gain is 27. Applying 20%, your tax outgo would be only 5.48. So yes, if the gap between your sale value and the index cost of acquisition or improvement is less, then maybe the old tax regime or the old scenario of 20% plus indexation would be beneficial to you. Now, as the gap increases, okay, if you see the last column, let's see that the value of sale was 200 and the index cost of acquisition is 72. There you see that the long-term capital gain of 20% plus indexation will give you a tax outgo of 25, whereas without indexation, 12% would give you a tax outgo of only 22. So briefly, but again, this is not applicable in all scenarios. In general, if the gap between the sale value and the index cost of acquisition is higher, then the new tax scenario, which is 12.5% without indexation, would be beneficial to the individual. But again, there are a lot of other nuances that we have to consider here. Again, if you see the first case, the long-term capital gain is 80, and in the new scenario, and in the old scenario, the long-term capital gain is 27.4. So if you want a Section 54 exemption, you want to invest in another house property, and if you want to get some tax relief, or you want to invest in some specialized capital bonds and get some tax relief, in the existing scenario of 12.5%, you will have to invest that 80 lakhs. Whereas in the old scenario, you will be investing only 27 lakhs. So when you see the benefit point of view, it is not just the um, uh, the tax outgo part alone that we have to see. We have to see the tax saving part also, which is kind of missed out often. So everybody is concerned only about how much tax I have to pay, what is the tax outgo, and we do tend to overlook the savings part. So if you want to save a capital gain in this scenario, and if you want to invest in your house property here, the gain value, if you see in all the cases, let it be the first, second, or third, is higher than the cases with indexation. So the amount of investment that you have to make to have that kind of tax saving or to reduce the impact of the tax outgo is quite higher if you see the investment requirement without indexation. Now, what about listed shares? Let's quickly see two scenarios that is given here with regard to the listed shares. Now, let us see the scenario one. You have the old taxation. Old taxation, here we are referring to the 10% short-term capital, long-term capital gain. And the new scenario, new taxation, here we are referring to the 12.5%. So there is a profit of 3 lakh in scenario 1. So they have given you an exemption of 1 lakh, which was available earlier. Now they have extended to 1.25 lakhs. Now the profit that you will get earlier will be 2 lakh, and now it will be only 1.75 lakhs. With the tax rate of 10% and 12%, you see that if it was 10% tax regime was followed, your tax outgo is 20,000. Now that it has been made 12.5%, that is long-term capital gain on sale of equity shares has been made to 12.5%. Your tax outgo slightly increased to 21,000.875. Now, what about the second scenario? Second scenario, you see there is a gain of 2.25 lakhs. Okay. Applying the exemptions available, we can see that the tax outgo is kind of same, whether it is 10% or 12.5%. So we can roughly say that this 2.25% is of profit is the break even. it is the point which doesn't have much of a variation, whether it was a 10% taxation or a 12.5% taxation. So once you cross or breach this 2.25 lakhs of profit, so then you will see that your 12.5% tax outgo is slightly larger and kind of pinch on your pocket. Yes. So unlisted debentures and bonds. So the unlisted debentures and bonds, what is the amendment that has been made in the Finance Bill of 2024 is that they have they have clearly mentioned that irrespective of the period of holding, your unlisted debentures and bonds will be taxed at short-term capital gain, that is 20%. So the earlier table that we saw with regard to the period of holding, where it was mentioned that the unlisted debentures and bonds will be having 24 months holding period to decide whether it is a short-term capital gain or long-term capital gain becomes wholly irrelevant, because under section 50AA, they have brought in an amendment that whatever may be the holding period, the sale of your unlisted debentures and bonds are going to be taxed under short-term capital gain only. There is no question of long-term capital gain here. Yes, they have made some increase in the security transaction tax of options and futures. So whoever is trading in options and futures, they will be able to view this or feel the impact of the change applicable from 1st October 2024. Again, buyback of shares. Yes, buyback of shares earlier, it was taxable in the hands of the company at 20%. Now, through the Finance Bill of 2024, the amendment that they have made is that the buyback of shares will be treated as deemed dividend and taxed in the hands of the shareholder. Earlier, the buyback of shares was not taxed in the hands of shareholders. It was the company's liability to pay the tax at 20%. And yes, that liability also came up with some consideration to the companies. They had a different method of calculation there, which we needn't look into right now. So as a shareholder, if you are a shareholder and there is a buyback coming up, so please be prepared to pay tax on that deemed dividend, which will be computed on the event of buyback. So let us see the scenario. Sarupa, can you please confirm if I am audible?
Yes, ma'am.
Yeah, thank you. So yes, so let us quickly have a case study here with regard to the buyback of shares. So a company, you have bought 1,000 shares from a company and the cost of acquisition is around 40,000. Now 200 shares were bought back from you in the financial year 24-25 for 60 rupees, and the 500 shares were sold in 25-26 by the company for 70 rupees. So what is going to be the impact in the hands of the shareholders? So this 60 rupees of buyback is going to be taxed as a deemed dividend in your hands. That is, the company is giving you 60 rupees for 200 shares and buying it back from you. The entire proceeds that you are going to get out of this buyback will be considered as deemed dividend and tax on in your hand. We can be happy that they were kind enough not to tax it as a capital gain. So at least there is some relief in that aspect. And another very, very significant change and very welcoming change for our salary class is the amendment that they have brought in with regard to the TCS credit. So till now, we were not eligible to provide the TCS credits that are available to our employer. So we have to wait till the end of the year and file our returns to get any refund that we are eligible in this regard. And believe me, the refund value is quite huge for those who are sending their children abroad for foreign education. So yes, from financial year 24-25, you can provide these TCS credit details to your employer and request them to adjust your tax deductions accordingly. So the employer can very well consider the your TCS credit and then rework your TDS on salary, which he has to deduct. So the time gap that you have to wait till the end of the year to get your money back is very much brought down because you can adjust upfront against your salary TDS account. Yes, this change is also effective from first day of October 2024. Another important amendment that has been brought forward in your Finance Bill 2024 is the changes in the TDS part. So several TDS have been shifted from the 5% rate to 2% rate. Like commission has been made 2%, and your insurance commission is reduced to 2%, and your HUF is made 2%. And the date effective is also given here. So majority is on 1st of October 2024 that these changes will be effective. Luxury goods, yes, this is another important thing that if you are planning to buy, a Gucci or a Versace bag for yourself. Uh, Earlier, this luxury goods TVS was applicable only for motor vehicles. If you're buying a luxury car, like 10 lakhs, the government of India is telling that 10 lakhs above is a luxury motor vehicle. So you have to pay a tax. TCS will be collected from you for 1%. So only the motor vehicles were there in that classification of luxury goods, 10 lakh and above. Now they have extended to all the goods. So any goods that you are buying, 10 lakh and above, you will have to pay TCS on that. So if you are buying a branded bags or some, luxury products, then yes, you will have to pay TCS on that for 1%. And the amendment is again effective from 1st January 2025. Non-resident TCS, TDS has been changed. Yes, for long-term capital gain, they are impacted to the same extent. So they are also brought into the same line, which is that of a resident. So any changes that we have discussed so far for a resident, the same thing is going to be applicable for a non-resident as well. Yes. So if you are an employer and some corrections have been made in your TDS or TCS return, earlier there was no timeline. So I have seen personally working in an organization where certain returns which were like older to 10 years were also still revised. So if somebody comes up and say, I haven't received the credit for that particular entry, and after 5 years, and then still those TDS returns were revised. So that has been made a restriction here. So as per the new amendment, you will be able to revise your TDS as well as your TCS returns only up to 6 years. So if you have any TDS issue with your employer, please take it up immediately because there has been a timeline that is fixed for rectification of the same. Yes. So this is all the various amendments which will be impacting a salary or proper middle class family. So yes, the finance bill has focused on the new tax regime which is going to be there going forward. So the government is focusing more on the infra development of the country and on the startups, how the corporate structure, how industries can be developed. So the tax, the savings part, your personal savings part, your insurance part is completely the individual responsibility. So I would suggest or I would recommend that for those who are stepping into their career, the freshers who are starting up their career, they do give significant importance to certain savings also. So it is not like you earn and you spend. We are not living in a Western country. We can't afford to do that. We have to save. We have for the protection of ourselves as well as our families. So on that note, I complete my presentation here. I hope I was able to give you a brief idea about the amendments that was brought forward in Finance Bill 2024 so that you can make an informed tax planning or tax saving. Thank you.
Thank you so much, CA Deepa. And thank you everyone for joining, for giving your some time to learn about our new budget and how it impacts each of us. Thank you so much for joining and have a great day. And if you have any queries, you can give a message in the number that is shared with you. So you can just get that. Thank you so much, Arun sir. Thanks for your reaction. Thank you so much. Thanks, Turai sir. Thank you, Subramanian sir. Thank you so much.